Welcome to the What to Watch video update. This is the last video that I do each week, where I do a number of different videos throughout the week. Well, at the very end of the weekend, I take all the charts and I pick out those that I'm really focused on for right now, and I come up with a positive list and a negative list. Now, that's not a real dogmatic way to list these because even on the positive side, there's negative things that we're watching. And even on the negative side, there's positive things that we're watching. And there are things that I have on the negative list that are not necessarily negative, but they're things that we're watching for and we're keeping an eye on them because the market may deem them as very important. So this is being prepared for Tuesday, September 3rd. I do have a thing called the SPX investing program. It's free for right now. It'll probably be free until October, depending on an upcoming trip, whether that's going to happen or not. But there are additional videos that I post there. You also get immediate access to the videos as they're prepared and uploaded, where you have to wait to see them on YouTube and Rumble. Also, I come up with some trade ideas. You can have more interaction with me. We can set up times to talk on Zoom or Skype or what have you. If you want to go to the actual website, there's a link below this video in the description. Also, if you want to contact me, here is an email address, and you're welcome to do that. It's very common these days where someone contacts me and I actually respond with a video. It's just a response to that particular email. It's a lot easier for me to do that and faster to do that than to spend all the time writing an email. So if you want to have some more back and forth or set up a time to talk, please feel free to do that. The daily video is what I do the most of my analysis and commentary around and on and in. All of the other videos around the outside, including this one, the What to Watch video, they are supplemental videos because what I'm watching right now is slightly different than what I was watching a week ago, and it may be something different that develops during the middle of the week in the upcoming week. So that can change. Even though this is a weekly video, I go over things as they're changing and developing in the daily video. So if you want more analysis and to try to develop some foresight as to what's going to happen, please tune into the daily videos. They're available right when the market closes for that particular day. Now, if you want to have access to them anywhere from 12 to 16 hours before that, become a member of the program and you have immediate access to those. All right, let's go through and look at the positive things. We did end the week positive. Now, you could look at this chart and go, oh my gosh, it looks like a machine gun went here. This is an intraday chart of the S&P 500. All of these bars, or each one of these bars, is 10 minutes long. If it's up, it's green. If it's down, it's red. And we were quite choppy. We've been going sideways when you look at the daily chart that I'll show you here in just a moment. But we ended up really spiking up at the end, and that gave us a slightly positive week. But we're also bumping into overhead resistance. We've been in a range. Right now, we're at the top of that range. If we fall from here a bit, we are going to be probably near the bottom of that range. The question we're trying to figure out now is, now that August is done, Labor Day will be finished, folks are starting school, folks are coming back to work, vacations are done, barbecues are done. Is volume going to pick up? Is the smart money going to come back and really drive the market higher or lower? Now, we're potentially coming into a weaker part of the year. September tends to be the worst month of the year for stocks. Doesn't mean they're always down, but historically, we want to respect that. There are some positive things that we can latch onto. There's also some negative things that are giving us a little bit of a concern here as the market appears to possibly be setting up to be more defensive. And I'll go through that as we go through the video. This is the daily chart showing how we've been just chopping sideways lately. Now, we do have a pivot point here right above current prices, and we're still below the all-time high for the S&P. We'll have to see, are we going to break out to the upside and set a new all-time high, or are we going to break down? It'll be kind of disappointing if everybody comes back and we continue to chop sideways, but that's the environment that we've been in. We're actually not trending right now in the short and intermediate term. But we're still looking positive here. We have the 50 period above the 200 period and prices above both the moving averages. Where we've been really below average with volume now on Friday, that was the last day of the month and of the week. And so we did see a pickup in volume that day. That was above average, but all the other days, and pretty much what we've been seeing is when we were going down in August and the latter part of July and into the early part of August, we saw volume really picking up. And then as we've been bouncing back up, we saw volume really going down. That's a classic negative divergence. Now you can rationalize that away and say, well, it's August, it's vacation, and people aren't really focused on the market as much. And that's probably true. But when we're looking at a chart like this, we don't take any of that into account. We just say, okay, here's price, here's the indicators, and here's what volume's doing. We don't really try to rationalize it away in that sort of a way. So that would actually be more negative with volume going down as price has been going up. Excuse me. Now, another thing that's positive here is sentiment. When we were coming down in July and into August, we dropped below 25. That's where we start looking at using sentiment as a contrarian indicator, and that's proven to be quite effective. We bounced up back above 25, and now when it gets no longer extreme negative here, we go with it. And then when we cross above 50, that's when we turn more positive, and we chopped around here for a little bit. Right now, we're above 50 as well. So we tend to go with this until we get up around or to or above the 75 level. That's when we start looking at this going, okay, maybe folks are a little too happy with this right now. This is showing extreme optimism. Now let's look at an opportunity to use this as a contrarian indicator. But we can stay up at these higher levels for quite a while when the market's really chugging to the upside. But we just want to be aware of that as it's developing. Then we look at moving averages that are placed on the S&P itself, and we're looking a little extreme with the 20, just barely extreme with the 50, and starting to get extreme here with the 200. So this we use like an oscillator, and when we start to get extreme positive readings right now, it may mean that we slow down, it may mean that we reverse, but we can also still go higher than where we're at right now. So we just use this to tell us the condition of the S&P. We look at the condition of the short-term trend, the 20-period trend, and there's a number of different ways to look at this. One is by looking at a double and triple exponential moving average based on 20 periods. And we're coming down into the lines here, but the lines are still going up. When we're more positive, we're above the lines and the lines are going up themselves. The fact that we're coming down as we've been going sideways lately is a little bit of a concern, but at the same time shows that the short-term trend continues to be positive. Then we use regular moving averages, a simple and an exponential moving average, and we're above both lines and both lines are going up. That also confirms that the short-term trend is still positive, even though we've been going sideways. But we're getting a little far away from that 20-period moving average. With the upsurge that we saw in Friday's session, this is the boom indicator, and it measures how far above or below we are in reference to a 20-period, 50-period, or 200-period moving average. Now, when we're going up or down, we roll with that, kind of like we do with sentiment. But when we start to get extreme, it's like, okay, we're a little bit concerned here because price has the tendency, once it gets too far away from a moving average, it will snap back. And that's why we call this boom. It'll go out far away and then boom, come back. And that works to the upside and to the downside. What we're seeing right now is a little bit of an extreme reading here. Now, it could still go up more than where it's at currently, but this is when we want to take notice of this. We are looking positive, but not extreme positive with the 50, and also kind of chopping around, but still looking positive here with the 200. Then we look at the condition of the intermediate term trend. That's based on 50 periods. That's how I measure them. 20 periods is short, 50 is intermediate, and then anywhere from 100 to 150 to 200 is a long-term trend. Mainly the long-term is 200. This is still holding up. We're above the blue line and the red line, even though we've been going sideways and both lines are going up. This would turn more positive. If we start to go up and the red line breaks above the blue line, it moves faster. So we'll have to see if that's one thing that develops. But for right now, the intermediate term trend is still positive. Then we also look at simple and exponential moving averages. Even though we've been going sideways, we're above both of the moving averages and the moving averages are going up. Then we plot a bunch of different simple and exponential moving averages here, and we're above all of these lines. This is suggesting on a trending basis that we're still positive even though we've been going sideways lately. Then I usually show this in the deep dive video. This is a rainbow chart, and it looks kind of cool because you change the colors and all that. I have three of them. I have a short, intermediate, and long-term chart. And first, we'll look at the short-term chart. This goes from 10 periods up to 50 periods. We're above all of the lines in the rainbow, and all the lines are starting to turn up. Now, this reacts the quickest since it has the shortest term moving averages. When we were falling down, we were kind of turning into spaghetti here with these moving averages. But since then, we've been able to come back up, and it's showing a lot of improvement here in the short term. Then we look at an intermediate term. Also, we fell down well below the rainbow, but we weren't there very long. We bounced right back up. So we saw a little bit of a blip here with the intermediate term trend, but not a lot of damage was done there. And these moving averages go from 50 periods up to 100 periods. Then we have a long-term rainbow. We came down into the middle of the rainbow, shot up out of that, really didn't change any of the lines here because that didn't really last for very long. And this rainbow goes from 50 periods up to 250 periods. And so looking at the short, intermediate, and long-term based on moving averages, we still remain positive. Then this is not only positive, but also a concern. These are the stocks in the S&P 500 that are above their 20-period moving averages. When we get above this 80 level, that's when we start to look extreme. Right now, we're into the 90s. We have 91.8. I don't know how you get 0.8 of a stock, but when you deal with percentages, that's how it works. But we're getting a very high reading here. And a lot of times when you see high readings before, it doesn't necessarily mean a reversal. It just means that we might continue to go sideways based on this. Now, there are times when we topped out and then eventually started going down. So we want to be aware of that as well. Then we do a moving average study here. And when we get above 70, that just shows good solid momentum in the short term. And that's what we're seeing. But also, just like the other chart, we're seeing a really extreme reading here. We're looking positive with our stocks inside the S&P above their 50-day moving average. We're above 50 and going up. This is showing that the intermediate term trend continues to be positive. Then we look at those stocks above their 100-period moving averages, still going up. We're a little bit concerned if we get up to this blue line here. That means we're getting a little too extreme, but we're not there yet. And then we're also going up and getting close to this blue line with those stocks above their 200-day moving average. But for right now, on a trend basis and those stocks inside of the S&P, everything is looking positive. We're just a little bit concerned in the short term because we're quite positive. Then we look longer term. And on top, I have a 50-period moving average. I really just use that for reference. And we're above this red line, suggesting that we're getting kind of extreme here. And I put these lines on here, so there's nothing magical about them. I just use them as reference points. We're also getting a little extreme here with the 150 and the 200. Now, we can go higher, and we've been higher than this before. I just kind of eyeball this over a period of time and go, okay, right around 350. That's a good place to put this. Well, let's go with 350 here as well. So we don't just immediately say things are going to reverse when we get to these levels. I just use them as guides. All right, then we look at a weekly chart of the S&P. This is still looking quite good. We're above this R2 level. We close pretty much at the high for the week. Each one of these bars is a weekly bar. And so on this, we're looking good, but we have not come back and set a new all-time high yet. And we look at those stocks in the S&P, and are they making new highs or new lows? This is a 50-period exponential moving average. When this is going up, that means that most stocks in the S&P are making new highs right now, and that's healthy. That's an internal measure that we look at, and with this going up, that is more positive. Then we keep an eye on the fear gauge. This is the VIX, where we really spiked up right on that down day on August 5th. We've been coming down. We're not at really low levels now, but we're well off of the readings we were getting, both with the line chart and the bar chart. And then there's the VIX of the VIX, which measures the volatility of the VIX. When the VIX is going down, the VIX of the VIX also has a tendency to go down, just showing volatility is decreasing, and we're usually going up. We're also seeing where the MACD is suggesting that we're still in a downtrend as far as momentum of the VIX. Now it's rolling up a little bit here, and we're coming off of this astronomical reading that we've seen compared to what we had been seeing. But for right now, the overall momentum of the VIX continues to be lower. Then Tom Bowley from StockCharts.com and Earnings Beats, He put out this study almost a year ago now, and he came up with the figures that you see here. And what happens on an annualized basis when the VIX is at certain levels? That's what he's trying to figure out here. Now, the figures are old, but this is updated as of Friday. This is a weekly chart of the VIX where we closed at 15. So we're right here. We still see positive annualized returns, not as much as when the VIX is lower, when we see even higher annualized returns, but more than if we go up with the VIX here. When we get above 20 with the VIX, that's where we start to see negative annualized returns. So right now, we're still in a positive area as far as his research is concerned with the VIX. Then there's another related type of VIX indicator called the skew index. When they calculate the VIX, they use at the money options, whatever those are at that particular time. Well, the skew index looks at out of the money options. Now, this is a little harder to read because when we get up into this red area, which we've been in now for the last few days, the market is expecting some kind of a big move. Well, you could be dogmatic and say, we're going down, we're going up, we're going sideways. Well, look at the red lines here, and you can make a case for any of those. So this just tells us that the market thinks something big is going to happen probably after Labor Day now. It'll have to be. But it doesn't necessarily help us with the direction of how things are going. We have to use other charts to get some context for that. Then we look internally at the S&P. We are breaking out, setting a new all-time high based on price. We've kind of come back up to this previous high here based on volume. This has been a little bit of a concern to us where price has been leading volume. In a more healthy environment, we actually want to see volume leading price, but this is still looking positive, and both price and volume are above their moving averages, and the moving averages are going up. Then we also look internally at the S&P at the new highs, new lows, continuing to see a real expansion in new highs. But since we've been chopping around a little bit and coming down from recent high readings, the 5-day is starting to roll over, but it hasn't quite crossed negative yet. But the 10-day continues to go up. Then we look at a longer range of highs minus the lows here for the S&P over 10 days. This is showing that the momentum for the S&P is quite positive right now. This is actually showing that it's not just a few stocks that are really driving the S&P higher. In fact, those stocks are not really doing all that well right now. The Magnificent Seven, the mega caps, and so forth. It's the rest of the S&P that's really been keeping the index higher and have it, at least this week, be the best performing index that we look at. And we look at the advanced decline ratio, starting to get extreme on a short-term basis based on 19 periods, still looking positive and going up based on 39 periods. And then here's another breakdown of that, where we're getting extreme based on 19 periods. When we look at price, we're coming up, but we're not extreme yet based on volume. This is positive when you look at it based on price. This is a slight negative divergence when you factor in volume to the equation. Then another smart money indicators, accumulation distribution, we're above the moving average going up, and the moving average is going up. This tries to measure how far away we are from the moving average, and you can see we're not all that far away, but this is not a true measure here. This is just suggesting that maybe we're getting a little extreme, but if you see a discrepancy here, go with what you see in the chart, not necessarily what this indicator is telling you, because it's not always an accurate representation of what's happening. And the Chaikin money flow, another smart money indicator, continues to go up. That is positive. This has been a concern where we're seeing the Chaikin oscillator, another smart money indicator, where it had been declining. Well, it turned back up a bit on Friday. Now, if this keeps going down, that will be negative. If this can keep going up, that would naturally turn things more positive. We look at the vortex. Also, this is positive since the green line's above the red line, but we're a little concerned because we see the green line coming down and the red line coming up, but this is still positive. Then we look at the S&P 500 advanced decline line on a cumulative basis based on price, breaking out and setting a high here, and just barely breaking out based on volume. We've been a little concerned about this, where volume wasn't doing quite as well as price, but now we're seeing a bit of an improvement. Then we look at the new highs minus the new lows, and on top, this is similar to the chart I just showed a little while ago. This, on top, the black bars here, that's just the daily score. And then on top of that, I have a 50-period exponential moving average, and this also continues to go up. So we're positive on a daily basis and also on a more intermediate term basis. Momentum continues to be positive, but with our short-term oscillator, the slope, we're getting really extreme here. And it hasn't rolled over yet. It could at some point, and most likely will. And that's when the short-term momentum may actually turn negative. But when we look at our other short-term oscillator, we're just going above the midpoint and still looking good, even though we're slowing down a bit. We're seeing a bit of a rollover here with our three intermediate term oscillators, the MACD, the PMO, and the PPO. So they're still positive, but the fact that they're slowing down a bit is a concern. Well, when we look at the long-term oscillators, the tricks in the KST, my goodness, KST, they continue to be positive. All right, now this is a whole different way to measure what's going on in the S&P. This is the bullish percent index, which measures the buy or sell signals generated by point and figure charts. And this continues to go up. This is also suggesting that the rest of the S&P is really leading things and holding up quite well, instead of it just being a few stocks. And we're not necessarily getting an extreme reading. We're positive when we're above 50 and advancing, and that's what's currently happening. We also look at the bullish percent index for the NYSE. This is looking solid, above 50 and going up. Now we're seeing a little bit of weakness here because the big mega caps, the NASDAQ 100, the stocks that everybody loves and talks about, well, we're seeing a little bit of weakness after getting an extreme positive reading here. So this isn't quite confirming the strength that we're seeing in other indexes, but it's still positive since we're above 50. And the parabolic SAR is positive here on the daily chart. I don't have the weekly chart, but it is also positive on the weekly chart with dots underneath. Then we look at the McClellan oscillator for the S&P going up, almost getting into extreme positive land here. And this is more short to slightly intermediate term. When we're above zero and going up, that's positive. And when we're positive here, that means we're going up based on price with the summation index. This is more intermediate to even somewhat long term. And we're going up above this level. Now, we could say when we get above this red line, maybe it's a little extreme, but as we've seen before, we can still go above that. What we were watching earlier that was concerning us is that price was going up, but volume was starting to turn down. Well, after Friday, volume is now turned back up. And if they're both going in the same direction, that's more of a confirmation for each other. Then we look at the NYSE McClellan oscillator, also above zero and going up. So when we look at the summation index, we're going up based on price and volume, and that's pretty healthy for the broad market. Then we look at the S&P 500 and compare it with the NYSE advanced decline line. This, when it's above the bar chart, even though they're on different scales, you can see other times when the S&P does really well, usually when the broader market is also participating, that's stronger overall. And this is just suggesting that not only the S&P is doing well, but the NYSE is also doing quite well. Then we look at some NYSE studies, the cumulative advanced decline line based on price, breaking out, just barely setting a new all-time high. That's one way to measure advanced declines. Another way is calculated here, setting a new all-time high with this. Then we look at another NYSE advanced decline line, which is calculated in a slightly different way. This is being confirmed since this is also breaking out to a new high. Then we break it down a little bit more. We look at common stock based on price, setting a new high, common stock based on volume, setting a new high here. So the broader market is actually looking a bit stronger than the S&P right now. We look at the advanced decline lines, still looking really good here with the NYSE common stock, the S&P, the mid caps, and the small caps. And then we look at the S&P, which is a weighted index, and we compare it with an unweighted or equal weight version of the S&P. This also shows that the rest of the S&P is doing better when the red line's above the bar chart, even though they're on different scales. Then we look at another way of measuring the ratio between the two. When this is going down, that means the S&P is underperforming, and then it started to go back up. Now it's going back down. It's getting really choppy right now. But the fact that the equal weight is doing better just means that the upward movement is more broad-based right now. The Dow set an all-time high in Friday's session, so that's positive. The NASDAQ was able to get back above its 50-day moving average, but still below this pivot point. That's a little bit of a concern there. The NASDAQ 100 also got above its 50-day moving average again after falling below that, but right at this pivot point. So we're seeing overhead resistance. And what I've noticed is these pivot points, which I update every day on the YouTube community tab, not for the NASDAQ and NASDAQ 100. I just update them for the S&P. But these pivot points tend to be quite important when it applies to the NASDAQ and NASDAQ 100. Then the QQQs just barely getting back above their 50-day moving average. So that's somewhat positive there. The momentum for the NASDAQ 100 is still positive, even though we're starting to roll over a bit. The small caps looking positive above their 50-day moving average, above this pivot point, but really not breaking out now. We were in a tighter range for a lot of 2024. We'll see. Are we really going to be able to break to the upside, or are we going to get another fake out here and then see the small caps really pull back? And here's another small cap index, the Russell 2000. We're above 50 with the RSI. We're above the 50-day moving average, and the momentum is positive. And then we look at a ratio between small caps and the tech sector. When this is going down, that means the tech sector is outperforming. We started to bounce back up. We're pulling back, and now this is starting to go up again. At least late in this past week, small caps did better than the tech sector. It's a little bit of a concern to us. The mid caps not really breaking out yet, but still above their 50-day moving average and above this pivot point. And the Wilshire is a broad market measure. We're above the 50-day moving average, but not setting a new all-time high, and it's pretty much been going sideways lately as well. The total U.S. stock ETF also going sideways near an all-time high, above its 50-day moving average, but going sideways too. And then we look at a ratio between the QQQs, the NASDAQ 100, and small caps. We're right around this pretty high level now. A lot of the perma bears, they thought we were going to come up, hit this, turn, and then just go in the toilet after that. Well, no, that's not what has happened, at least yet. The financial sector, probably the strongest sector these days, going out, setting new all-time highs. That's good. We want to see the financial sector doing well. That means the economy's looking okay. That means that we're not necessarily looking at a financial meltdown, at least at this point. But we want to keep an eye on things nonetheless, because things can change quickly. And we look at a ratio between the financials and the S&P. Even though it's still in a downtrend, we broke out above this, and we could be seeing a golden cross here with this ratio. And then this is also encouraging. We compare the regional banks with the financial sector, seeing a golden cross with this ratio after a lot of weakness. Now it's starting to show some improvement. And what's been helping stocks going up are interest rates going down. Now, they did go up in Thursday and Friday's session. That's a little bit of a concern. If they continue to go up, that may pressure stocks. If they keep going down, that could give support to stocks. But the market is still anticipating a soft landing, meaning that we're not going to go into a recession. We're above this rainbow and going up, even though we're not back to the all-time high yet with this ratio. We look at the broad market, the S&P 1500, and compare it with 1 to 3 year bonds. We're above the rainbow. That's positive. We look at another broad market measure and go further out with 3 to 7 year bonds above the rainbow. That's positive for stocks. The tech sector, though, is not doing all that well. I could have put this easily on the negative side here. We want to see this breaking out above the rainbow. It's actually still inside of the rainbow. And then we look at risky versus not as risky bonds, where we had been falling down here. We're starting to come back up. Now, riskier bonds usually mean junk bonds. And when this is going up, that means folks prefer junk bonds because they're willing to take on that risk to get a better yield. When this is coming down, they're favoring government bonds, either because the economy is falling apart or interest rates have topped and are going to start to come down. That's why we were seeing this coming down. But what we need to do is keep an eye on the context. When this really fell, that's when the market had developed, at least for a few days there, that the economy was getting ready to fall off a cliff. Well, now that we're kind of going back to this, maybe things aren't so bad after all scenario, we're seeing this ratio going back up slightly. And we look at the Eurozone. These are stocks in Europe compared to American bonds, just peeking its head a little bit outside of the rainbow, showing some improvement there. And then home construction is still above the rainbow. It really shot up, fell back. Now it's starting to show some improvement. And this is a very highly interest rate sensitive part of the market. So if interest rates continue to go down, we would continue to see this ratio going up. Then we look at a ratio between the NASDAQ 100 and the Dow. Again, this is another one that the perma bears thought we were going to come up, hit this, turn, and go in the toilet. No, we actually went and set a new high with this ratio. Even though we've been declining, we're still above these previous levels. Look at a weekly chart of the NASDAQ 100, still above this trend line going back to 2009. We look at another ratio of semiconductors, a massive part of the tech sector, showing a little bit of weakness here, a little bit of a concern to us, but we're not all that far away from these highs. Now, if this really starts to go down, that would be more negative, and we want to keep an eye on that. Then we look at large caps versus small caps. When this is going up, the large caps are outperforming, and then small caps found some love there for a while. But then we went down at the beginning of August, and then the large caps came roaring back, and not really getting an awful lot of insight from this particular chart currently. Large cap growth, also above its 50-day moving average. It's not really going up with any kind of strength, but it's not falling apart either. Then we look at the negative side. Now, we're still positive when we look at this chart. The definition of positive with the ADX is when the green line's above the red line, and that's what we see. But we see the green line going down, but the red line's going down, but we're dropping below the moving average. That means a weakening trend, and we're dropping below 20. That means we're entering a non-trending environment. And as I noted here, we've just been going sideways. We haven't been able to break out to the upside. Even though Friday was a good day, we didn't really go anywhere. We've been here before. So we'll have to see. Are we going to break to the upside, continue to go sideways, or break to the downside once September gets going? But for right now, even though this chart is positive, the warning signs here made me put it on the negative side. And we look at a short-term version of that same chart, which naturally moves quicker. We're actually going into a trendless environment as we've been going sideways. The green line is still on top, but it's declining. And the red line is also declining here too. This is not really helping us either. We want to see the blue line above the red line. This is an intraday chart of large cap growth versus large cap value. We see the red line above. And that might help the rest of the S&P do better. And it might help the broad market do better, but it's not helping the S&P to go higher. When we were really going up, the blue line was clearly above the red line. Now we see the red line above the blue line. Now they're both doing okay, and they're not really falling apart, but we want to see the blue line above the red line here. And this is also a concern. When we hit that low at the beginning of August, and then for the most part, we were bouncing up out of that, we saw growth for the S&P on an intraday basis outperforming value. Well, then we kind of topped out here, and now we've been starting to come down. And so this is looking a little more negative. It's not falling apart necessarily, but if this continues to fall, that would be more negative for the S&P. And we're not really seeing any help here. These are end of day charts for small cap growth to value going down, mid cap growth to value going down, S&P growth to value going down. We want to see the opposite of that. We want to see these ratios going up for the S&P to really go higher. We look at a growth ETF and a value ETF actually coming down. They were unchanged on Friday's session with this ratio, but we're coming down to the lower end of the rainbow here. When this really goes up, the S&P goes up. And we're not seeing that right now. Then we look at some other growth to value ratios. Qs to the S&P under a declining moving average. Discretionary to the S&P turned up, but still below a declining moving average. And large cap growth is underperforming large cap value. And we look at the large caps, mid caps, and small caps, all below declining moving averages. Discretionary, yeah, it's been improving a little bit here, but we want to see this continue to really go up and show more strength than what it's been showing us. And I'm focusing on the bottom area of this chart. This is a ratio between discretionary and staples. We want to keep an eye on this. We had a down week with the Qs. Now the Dow set an all-time high. The S&P was up slightly, but the Qs were actually down on the week. And so we just want to keep an eye on this little red candle over here. We want to keep an eye on what's happening in the employment situation. If it really starts to weaken, that's going to freak out the market, and they're going to think the economy is falling apart. If it gets too strong, that may threaten the rate cut that the Fed has promised to deliver on September 18th. If it comes in just right, the market is probably going to take that as positive. Now, what we've been seeing is a rise in initial jobless claims. Now that's starting to go back down. That means we're not falling apart as far as the employment situation is concerned. On Thursday, we're going to get another reading of this actual report. We also want to keep an eye on continuing claims. If this really starts to go up, that means folks are staying unemployed for longer periods of time, and that shows economic and employment weakness. Then to give it an idea, we're going to get an update on the unemployment rate in Friday's session. We want to watch the continuing claims as well as the initial claims, and I put them together on this chart to give some context. We are concerned about volume. The hope is that after Labor Day, volume will start to pick back up, but we're well below average. We're seeing a negative divergence here, the Swenlin trading oscillator, which to me, it's not a primary indicator, but it's better than a secondary indicator. It's kind of right in between. We're going up based on price, but we're going down based on volume. That's the negative divergence, but we're still positive since we're above zero with both. Mass index. This is one of those crazy indicators that tries to predict a reversal. Well, all of the parts of this indicator have now triggered. We've been going sideways since we were going up when all of this signal was actually triggered here. This is suggesting that we may see a reversal, but we're not seeing an awful lot of confirmation. We're seeing warning signs, but we're not seeing it played out yet in the charts. This is also positive on one hand. We're setting an all-time high with the equal weight S&P, but we're not. This is negative in that we're not setting an all-time high with the equal weight QQQs. Just the reverse of what we saw earlier in the year when the S&P was really going higher and the NASDAQ 100 was as well. So on one hand, you can look at this as positive. Others, we want to see the Qs doing better than what they've been doing. The staples to tech ratio, and this is going down. That means tech is outperforming. This is starting to go back up. That means staples are outperforming. Staples are more defensive. The FANG index, not falling apart, came down to the 200-day moving average on that big down day, but still below its 50-day moving average. So we're still below this shorter term trend line. We were able to get back above this longer trend line here. It would be more positive if we could get back above the shorter term trend line. Keeping an eye on the yield curves, because there's videos out there that you can find that say, once the yield curves go back to being uninverted or regular, that means stocks are going to crash. Well, sometimes yes, sometimes no. It depends on the context of why the Fed is cutting rates. We want to keep an eye on this. We're getting pretty close here with the 10 to the 2-year, but we're still inverted. We're a little bit further away with the 10 to the 3-month. So I broke it out. Here's the 10 to the 2, getting a little bit closer here. Actually, there's been some intraday periods when we've actually gone back to being uninverted, only to close back down and remain inverted. And then here's the 10 to the 3-month. These are the two yield curves that most of the market follows. At least these are the two that I follow the most. And we look at the Qs to 3 to 7-year bonds, still inside the rainbow, not really showing any strength right now. And the S&P to utilities ratio, not showing an awful lot of strength. That's a bit of a concern here. And the staples to S&P. When this is going up, that means staples are outperforming. We want this ratio to be going down. And the dollar, which is in a downtrend, it actually, we've seen a death cross here, but this last week it did bounce back up, and that could put some pressure on stocks. We also look at the 3-year, where we came down and we actually broke below this trend line. Now we're coming back up to the trend line. Is this going to provide some kind of overhead resistance, or are we going to be able to break through this trend line? We want to keep an eye on oil, mainly for geopolitical reasons. It's coming down right now, but if things really escalate in the Middle East, oil could really shoot up. And that would, in this context, generally be negative for stocks. We want to keep an eye on staples. This is a defensive sector coming in and setting all-time highs here, and actually showing some improvement when we do a ratio between staples and the S&P. Even though it's still in a longer-term downtrend, it has been bouncing back up. We want to watch this because a lot of times the smart money will start to get into these kinds of staples types investments before we're getting ready to head lower. Also, utilities. You could look at this as a growth area because of the whole green stuff. And we're really going out with the utilities, and they've been looking good. This tends to be more defensive. Or it could be growth because of electric vehicles and all these other things that are coming on the market. So we're not quite sure the context of this one. And we're kind of going sideways, but showing here lately how utilities have been outperforming the S&P. Healthcare, another defensive area. When you look at it all by itself, going out and setting highs here and showing some improvement, but still in a downtrend when compared to the S&P. Another defensive sector. If this keeps going up, that could be pressure for the S&P. We want to watch the 3-month yield because look at what happened back in 2007 going into 2008 when this fell off a cliff. This going down. It could be positive because interest rates coming down can also be positive for stocks. But if this really starts to decline, we want to watch that because we don't want to see a repeat of what happened during the great financial crisis. So thank you. I really hope you found this helpful. I hope you're having a wonderful Labor Day weekend, and I will talk to you in the next video.